Buy low and sell high. Sounds easy, right? But how do we actually figure out which stocks are undervalued and which are overpriced? PE ratio is one of the key metrics used to find out those hidden gems which are undervalued and will increase in value over time. Hi, this is Manisha. Welcome back to the channel. Let's discuss all about the PE ratio today. PE is a multiple that shows how much amount an investor is willing to pay for each 1 rupee earning of the company. That means कि आप उस कंपनी की 1 रुपये अर्निंग के लिए कितना प्राइस देने के लिए तैयार हो and is calculated as price per share divided by earnings per share. Earnings used here from the profit and loss account should be normalized earning. That means it should be exclusive of any kind of one-time income or expense. Let's take an example. If a company's price per share is rupees 100 and its earnings per share is rupees 20, then its PE multiple will be 100 divided by 20, that is 5. दैट मीन्स कि आप उस कंपनी के 1 रुपये अर्निंग के लिए उसका 5 टाइम्स यानी कि 5 गुना ज़्यादा देने के लिए तैयार हो. नाउ लेट्स अंडरस्टैंड हाउ दिस रेशियो हेल्प्स अस इन इन्वेस्टिंग. P ratio is an important ratio to look at while investing because it reflects the investor's sentiment about the company. And to understand these sentiments, we need to understand the interpretations of the PE ratio. A high PE ratio means investors are willing to pay more for each 1 rupee earning of the company. And it can indicate two things. First, investors are ready to pay a premium for the company because they expect future high growth rate for the company. And second, it can also mean that the stock is overvalued. That means its current market price is more than what it actually deserves. In the same way, a low PE ratio means investors are willing to pay less for each 1 rupee earning of the company. And it can also indicate two things. First, investors are willing to pay less because they expect lower future growth rate for the company. And second, it can also mean that this stock is undervalued. That means its current market price is much less than what it actually deserves because investors may not have realized its true value yet. But how do we find out whether a PE ratio is high or low? For that, we need to compare the company's PE ratio with its historical PE trends and its peers in the same industry. For example, if a stock's PE is 30 and other companies in the same industry have PE of 15, that company might be overvalued. In the same way, if a stock's PE is more than its historical average, it might be overvalued. But here's the catch. This high PE ratio may be justified with high growth expectations. And to find out whether a stock with high PE ratio is really overvalued or it's just due to high growth expectations, we use something called PEG ratio. PEG ratio is per unit growth PE ratio and is calculated as PE ratio divided by expected earnings growth rate of the company. For example, if a company has PE ratio of 20 and its expected earnings growth rate is 10%, its PEG ratio will be 20 divided by 10, that is 2. So PEG ratio helps you to standardize the PE ratio of stocks with different expected growth rates and make them more comparable. So you might consider a stock as overvalued if it has high PE ratio, but if it has high growth expectations, its PEG ratio that has growth rate in the denominator will be low. So if a PEG ratio is more than 1, it means PE ratio is more than the growth rate of the earnings and is considered as overvalued. If PEG ratio is less than 1, that means earnings growth rate is more than the PE ratio and is considered as undervalued. And if PEG ratio is equals to 1, then it is considered as fairly valued. Now let's come back to the PE ratios formula. Price per share taken in the numerator can be actual market price or its actual worth based on the fundamentals, also known as intrinsic value. So it can be actual PE ratio or justified PE ratio. Actual PE ratio uses current market price in the numerator and divided by earnings per share. This is the actual PE ratio prevailing in the market. Or justified PE ratio uses intrinsic value in the numerator divided by earnings per share. It gives us justified PE ratio that should be the PE based on the company's fundamentals. Now comparing the actual PE ratio with justified PE ratio provides us insight about whether a stock is undervalued or overvalued. So if actual PE ratio is more than justified PE ratio, this means that current market price is more than the intrinsic value and is considered as overvalued. If justified PE ratio is more than actual PE ratio, this means intrinsic value is more than the current market price of the stock and is considered as undervalued. In the same way, earnings per share used in the denominator can be the current earnings per share or the earnings expected for future calculated through valuations. It gives us two types of PE ratios, leading PE ratio and lagging PE ratio. Leading PE ratio uses future earnings in the denominator and lagging PE ratio uses current earnings in the denominator. PE ratio is a good metric, but sometimes it can be misleading. Let's discuss about that too. PE ratio is meaningless if earnings are negative. That means you cannot use PE ratio if the company has losses. Also, for cyclical companies where earnings fluctuate with economic cycles, PE ratio also fluctuates. During expansions, their earnings rises and therefore PE ratio falls, considering the price hasn't changed. And during contractions, when their earnings decline, PE ratio rises. To fix this and to get rid of the cyclical effect of earnings, we use Shiller's cape ratio, that is, cyclically adjusted PE ratio. And as the name suggests, it removes the cyclical effect of earnings by using the average earnings of past 10 years in the denominator. As I have mentioned earlier, PE ratio is a very good metric to look at, but it should not be the only factor for your investment decisions. Other factors like companies' fundamentals, management quality, competitive advantage, industry's growth prospects must also be looked at while taking investment decisions. That was all about the PE ratio. Thanks for watching. Keep learning. We'll see you soon with another interesting topic. Bye bye.